Welcome everybody, it's the Market Sniper and very glad to have back a fairly regular appearance guest, Joshua Saul of Pure Gold out of London. It tells me a wet and raining and drenched London. It wouldn't be any different during their midwinter. Joshua, very glad to have you back. CEO, by the way, and founder of Pure Gold, someone we actually affiliate with. They give excellent service in terms of your gold and silver procurements. We'll be talking more about why their particular issue, but we're here to talk about gold and silver generally. Joshua, welcome back.
Thank you very much. Good to be here.
So we've had an interesting year end, didn't we? Gold suddenly found its way back above 2,000. It got slammed pretty hard on the first instance, but has now crept back up. It looks like it's setting up a sort of staging camp now above its previous resistance. How's people's behaviors? What are you seeing from your side as someone really with a finger on the pulse in terms of buyers and sellers in the precious metals market?
Well, generally speaking, we've seen over 2023, we've assessed the entire market now that the year has finished. We've seen that sales were up 93% year on year. The majority of clients are worried about inflation. They're worried about the impact of war on markets. We've got a large proportion of clients who stated that they were worried about counterparty risk. You know, banks, building societies, funds. You know, we saw a huge drop in share value for NatWest and Metro Bank. I believe it fell by about 30%. And so we've got the commentators.
Outside of the US, sorry to interrupt, Josh. What is the significance of NatWest, the bank you were describing? What role do they play in the British economic system? There are a lot of US watchers and other country nation states.
Sure. Well, they're the best example of retail high street banks. And they're not alone. You know, we've got Metro Bank, which are probably international as well. But the banking industry in general is in tatters. Meredith Whitney, who predicted the crash in 2008, suggests that we're going to see a huge consolidation in the banking industry. That's probably a polite and candid way of saying that we're going to see banks collapse at some point. And so we've got a large proportion of clients that are very concerned about deposit protection guarantee. Some people believe that if the bank were to go under, they would not be covered for anything over 85,000. We've also got a growing amount of people that, you know, even if they were to have less than 85,000 in the bank, they're concerned that actually the deposit protection guarantee by the government is largely academic. And so people are less likely right now to start trusting banks and building societies. You know, if you look at it, on the one side, you've got a vehicle that is guaranteeing a loss to inflation. And then on the other side of the fence, you've got an institution that, arguably speaking, has the highest risk of counterparty failure that we've seen in over 100 years. And so effectively, you know, you're exposing yourself to risk with literally no reward whatsoever. And I think the smart money have seen that, the rest of the market starting to follow suit. The other interesting thing that we've seen in terms of motivation, and this has come up quite a lot over the last 2 to 3 weeks, is the threat of cyber attacks with the use of artificial intelligence. We've got a lot of clients that work within the field of cyber intelligence, cyber security. They've harped on for years about the necessity for businesses, not just big businesses, but small businesses, medium-sized businesses, to treat cybersecurity, to treat it properly. You know, to treat it as you would do a lock on your front door in your house, right? Yeah. For a lot of businesses, websites, platforms, software, they are the life and soul of businesses. And so with the use of artificial intelligence, effectively, you've got kind of criminals, or you've got entities that can afford to be a lot lazier because they've got the use of software and platforms that can help them corrupt systems. Now, for some of our clients that have had little faith within digital markets, and therefore that motivates them to take physical, tangible asset classes that sit outside the banking system, i.e. physical gold, we're now starting to see that become a lot more mainstream. We're starting to see, everyday people very concerned about what a cyber threat might do in terms of the money in their bank, or for supposition, the gold they might hold in an unallocated fashion on a platform whereby they can't really decipher ownership. There are various platforms out there, peer-to-peer and otherwise, that give you exposure to the gold price. They do it with really sophisticated, impressive software. But at the same time, the counterparty risk, probably 20 years ago, wasn't really an issue. It's become a big issue at the moment because effectively your ability to sell the gold you've got is as good as the platform or the software that you're using to buy it in the first place. That for us, that for a lot of our clients, and Francis, we get to speak to every single one of our customers. We're not for everyone. We don't have the manpower to speak to the entire market, and that's for that reason we impose a very small and modest minimum. But we apply that consultative approach. We deal with a range of clients from investment bankers to accountants, but we also deal with post office workers and engineers and people that sweep the streets of London. The one big common denominator at the moment, the one big question that everyone seems to ask is, in the face of so much uncertainty, what do we do with our money? What do we, where do we put it? When do we do it? How do we do it? We've never seen as many questions that illustrate the fact that people have become paralyzed with choice. And I would say that it's not just for people that aren't necessarily financially in the know. We've seen some of the best trading minds completely stumped in terms of what to do. Going back to your question in terms of special buying habits, what we've seen is a 429% increase in clients removing exposure to equities, bonds, property within pensions and SIPs to purchase physical gold bullion bars within the same vehicle. This is a huge, huge area for us. People nearing retirement or wanting to rely on retirement to either extend the years of their retirement so they can stop working, or so they can, maintain the quality of their life when they do stop working. This is a huge area. For people to have, 10, 20, 30% of their retirement wiped out over a 3-month period, will that come back again? Sure, it may well take 7 or 8 years, but for a lot of people, they can't wait 7 or 8 years. Some people want to stop working, and if they want to stop working and all of a sudden they have to work for another 7 or 8 years because they've just lost 30%, well, you wait until that point and it's too late. And so in order to find yourself in a fortuitous position, one has to be proactive in terms of taking that prudent, conservative approach. The other thing we've seen is predictions. A lot of our clients aren't purchasing for growth. They're purchasing for safety, they're purchasing for security, wealth preservation. But I think what's impossible to ignore is the fact that we've seen central banks, the predictions for central banks later on in the year dropping rates, right? That's going to weaken currency. That's going to strengthen the value of physical gold. We've seen central banks already purchase in 2023 1,136 tons of physical gold. That's the single largest amount in any year in history. And already in this quarter, we're 15% higher than we were last year, right? And so we can already see, the evidence in demand, not just from a personal level in terms of safety and security, but we're seeing it institutionally. We're seeing it governmentally. For the same reason that, people on the street want to safeguard their wealth, we're seeing governments wanting to do exactly the same sort of thing.
That's impressive. I mean, when you reel off all those narrations, a record year of central bank buying, the first to know that things are at that point of unsustainability, or not to know, but to start acting meaningfully. This is the big giants are moving, aren't they? So that's got to speak something of it all. The one thing I find, I don't know if you have a take on this, but gold has gone up in spite of relatively high rates in comparison of what we've just had. And, whilst they're talking this pullback, it's going to be difficult to find a bid for debt, because for rates to come meaningfully down, there's going to have to be buyers in the debt market. And I'm just not seeing that.
Mm-hmm.
And it feels to me we've got two financial systems: the debt-based financial system, where the trust is gone, and now we're pivoting very strongly into the traditional physical financial system, which is the one of old, real original money. And I'm just curious what your take is on both the rates and the competition between the two systems.
Well, it's interesting because IG Wealth said at the end of last year that they believe physical gold or gold in general is undervalued by 20%, based on safe haven demand, but also the fact that central banks are likely to reduce rates later on in the year. And you're completely right. Normally, when you see rates drop, normally when you see rates increase, you expect currency to increase, you expect the value of gold to decrease. But we haven't seen that. We've seen the
Yeah.
opposite. Globally, we've got red flags abound. Both the UK and the EU are facing economic slowdowns certain to end in recession. The high interest rates are pushing real estate markets. Now, in the UK, we've seen mortgages in arrears up 29% from the previous quarter. That's 100% higher than 2022. The US government, once again, shattered debt records with 34 trillion in total debt. Right, that's adding 1 trillion in just 15 weeks. So even as the rest of the world increasingly turn away from the dollar, we've seen the likes of China dragging the world out of the last two crises, but not this time. We've seen Jinping just acknowledge the nation's challenge, admitting that companies have had a tough time and that people have had difficulty finding jobs and meeting basic needs. Now, this is the first time that we've ever seen Jinping speak about economic difficulties since he started giving New Year's messages in 2013. Need we even mention the ongoing wars in Ukraine and Israel? The shipping crisis in the Red Sea. We're currently navigating the most uncertain environment in a generation. But when we talk about debt, I really do believe that because we've been surviving on arguably free money for the last decade, you've got people that have borrowed more money than they could have ever afforded, right?
Yeah.
I don't believe the rates will ever go back to where they were. I do believe they may well come down at some point. But I think it's impossible to ignore that people are going to be paying 300 to 400% more than when they first purchased their property or when they first took out their mortgage product. When you take that and you add on a 400% increase in energy costs, and then you add on, depending on which metric you choose to follow in terms of inflation, a 7 to an 8% increase in inflation, it's a real struggle to understand how people are going to be able to pay for their cost of living. And will they have to start making a choice between their energy or their rent, their energy or their mortgage, their food or their mortgage? Everyone needs to eat. And so it's likely that the market, people in general, are going to have to start being proactive and selling property to avoid being in a situation whereby they're in arrears, because we're already starting to see that. In that situation, we're seeing an oversupply of property within the market, and that happens to be within a backdrop of, I would say, less buyers. There are
Yeah.
less buyers out there because, truth be told, people that are waiting to buy are excited to do so, right?
Yeah.
People that have sold a property, they're sitting in cash, they're excited to use that money to take advantage of opportunities as they present themselves. So arguably speaking, if we were to jump in now and buy a property at a 15% discount to where it was maybe at the beginning of last year, would that be a good deal? Well, relative to its high, possibly, but relative to where the analysts and experts believe the housing market might go, probably not. And so we've got subdued demand against a backdrop of increased supply, which therefore affects to a large extent the housing market. And we're seeing a lot of people over the last 12 months, a lot of people that have purchased physical gold because we get to understand where their money's coming from. For some people, it's money in the bank. For some people, they've liquidated equities.
Yeah.
And for others, it's a growing phenomenon of people that are selling property, wanting to buy another one, but actually deciding that now's not the right time to do it. And actually, if they leave their money in the bank, not only are they exposed to inflation, a guaranteed loss of purchasing power, but they're exposed to the highest amount of counterparty risk the banks have seen in a long,
Ever.
long time.
Yeah.
So the
100% agree with that. And to jump in on that, it's in essence, one of the things you were saying is it's actually okay for really smart minds, often them even financial traders, people involved in city jobs in London that are actually sitting here with you and they're not entirely sure how to allocate. And they're facing a collapsing property market with ever increasing monthly payments. And you've got this other equity market that's apart from the US equity market that seems to have a liquidity realm that goes for as long as it can until I suspect the cheap and easy money that was available to corporates. I mean, in America, there were corporates that were choosing to borrow instead of paying out of earnings on dividends because the cost of capital was cheaper than the cost of equity, to fund the equity. They've all loaded up debt on their balance sheets to maximize growth. The good old traditional approach of live within your means, keep debt very strongly under control, maximize earnings, don't, pipeline stuff and do all of these short-termist, almost control fraud strategies to maximize for a short spell and then leave almost a scorched earth policy. We're sitting in that kind of environment where there's been too much borrowing of the tomorrows, haven't we? It's conspicuous consumption into the future. Too much demand has been brought forward with super cheap money, and it seems like the piper has to be paid now. And that should bring about a lot of asset price disinflation in the hyper financialized assets. And outside of that sits gold that comes with no loan account associated with it. Is it really that simple?
It really is. If you look at the tech industry, for example, the tech industry is funded by and large as startups from VC funds that have never really had a better alternative than just taking a punt on possibly long shot upside, for tech industry. Some of them have done incredibly well because actually, if you think about it, some of these tech firms, whilst they make no money, the valuation of their firm is based on how much money they've been able to invest within their entity, right? And so, that they basically multiply how many shares they've got by how much they've managed to raise, and then every time they raise, their company's worth more and more money, despite the fact that actually this company hasn't really made any money and its burn rate is huge. So what's happened now is, a lot of these startups have become accelerators for wealth. When you look at VC funds and when you look at institutions that are deciding, do I put my money right now into the tech industry, or do I play it safe and put it into a government bond, or put it into something that's actually going to yield me something closer to inflation, as opposed to putting it into, startups that present right now far more risk than reward. That's what we're seeing. And actually, what you'll start to see now is that the valuation of various tech companies are starting to decrease because they're not able to generate as much wealth, generate as much investment as they ever have done. So going back to your question in terms of physical gold, you're right. It doesn't sit on anyone else's balance sheet. And if we talk about going back to what you were talking about in terms of very smart, intelligent, sophisticated investors, hanging up their hat and having the humility to say, actually, nothing makes sense right now. I look at equities and I think, okay, well, they're still continuing to go up. So do I want to take a risk in something that actually shouldn't be going up, something that should be going down? Am I on borrowed time? Or if I take into account that right now equities are at a discount to what they were last year, the big question mark is that a continuing trend? Now, most of the smart money will follow the smart money flow index. And if we look at price to earnings within the S&P 500, they're twice the median, right? Which suggests that we are massively overdue some sort of a crash. And so if you're looking at indices that have already started that descent, then one has to ask themselves, how much into that descent are you? If you're looking at an index that hasn't yet started it, I would say, are we on borrowed time? And so once you've looked at equities, you start to think, okay, well, that seems to be risk without reward. You park that and you think, let's move on. Bearing in mind that actually some of the richest people in the world get richer during times like this, during uncertainty and volatility and fear. They love it, right? And so is that possible for everyone else? Absolutely. But I think the wealthy are influenced very, very differently to everyone else, because what they're not influenced by is urgency, the need to act, right? Inflation over the last 24 months has created this burning desire to do something, almost anything, right? People have felt, well, inflation's at 9%, I'm losing 8%, I've got to do something, equity seems cheaper or property seems cheaper, and so I'm going to jump in. And actually, chasing opportunities leads to nothing more than wealth destruction. Sometimes the hardest thing to do is nothing and to wait cautiously for those opportunities. The opportunity has to be measured in value, not price. Price is what you pay and value is what you get. And so if we move on to, let's say, property is an asset class that I get behind every day of the week. It has a purpose, it generates an income. Property over the last 100 years has always outperformed most other asset classes. Plus it's physical, plus it's tangible, plus people actually need it.
Yes.
But the cost of debt is increasing, right? This is factual. The arrears are increasing.
And most people have mortgages. It's not as if 95% of the people have been cash buyers. It's not so much so necessarily at the super high end, although some will say there's more probably debt than you guess. But most people have debt on it. It's the financial engineering. It's in everything, isn't it?
Absolutely. And even people that don't need debt to buy property,
put it on.
They would still do it. Yields have decreased to the point where property doesn't really make much sense right now. But if we go back to the 1980s or 2008, we saw people fly in and pick up property at a 50% discount to what they were worth, 3 years before that happened. And so a lot of the smart money is still waiting and thinking, well, actually, unless I see something that's too good to be true, I'm waiting. I'm going to keep my powder dry. And then we move on and we think, okay, well, I'm not going to keep my money under my floorboard or on my kitchen table. Do I buy
bank, certainly.
Or a bank? And so you've got bonds. Bonds are paying more than they ever have done. But, the increase in yield is representing, I would say, probably more risk. If you're investing in corporate bonds, well, we've seen, more businesses collapse on the retail high street than we've seen over the last 20 years. That's saying something. Unemployment is increasing, which means that less people are spending money on consumer goods, and the cycle continues. And so effectively, you're lending money to institutions that are probably selling less of their items. They're paying more for the items they're trying to sell because of inflation. Um, and the banks probably are less likely to lend the money given the risk, the relative risk of those institutions. And so, yes, it's only right that they would have to pay more interest to encourage people to take that risk. The problem is, not only is it more risk, you'll never know if it was worth it until you get your money back. Um, but in some situations, it's still a guaranteed loss to purchasing power in a vehicle that you can't get your money out of in order to take advantage of opportunities as of when they present themselves, right?
Yeah.
So, then we move again, and we end up with cash. And we think, okay, well, cash provides us with flexibility. Yes, if we come across an opportunity, yes, we can take advantage very, very quickly. But then you've got the fact that actually you're losing more than you would do in a bond.
Yeah.
Guarantee. Yes, you have the flexibility, but the counterparty risk presents the biggest risk with no reward across all asset classes. And so a lot of our clients, traditionally, gold has always been seen as a long-term store of wealth, an insurance policy. But over the last 12 to 24 months, people have seen it as an active way of being able to wait for opportunities, a way of being able to park money in an asset class that is physical, tends to increase during times of uncertainty, outperforms inflation, can be liquidated instantly, and has various tax advantages whereby you're not paying any CGT under certain circumstances. You're moving it out of the banking system into an asset class that is completely private. And so, it's strange, Francis, because, 5 years ago, we were having the conversation. You have clients that have always known about gold. They've always loved gold. Over the last 24 months, we've had clients that actually they're indifferent as far as gold is concerned. What they've really got their eyes on, is property, undervalued, discounted, or equities, undervalued, discounted. Gold plays a part of a means to an end in order for them to see that opportunity, if that makes sense.
Oh, it absolutely does. It's as you said parking space, but it's a great parking space. It's even a long-term parking space where it is the strategy in of itself. So even if you want to be the vulture strategy, you want to pick up an amazing home for 50% off. And by the way, that was the 2008 crash. The 2008 crash never bled out to the fullest that it should because the quantitative easing spigots got turned back on. My overall opinion is you haven't seen anything yet, actually, if we get the full unwind of the total debt system. It has to be an absolute cluster bomb explosion, and it's going to have to be bigger, in my opinion. It's got to be substantially bigger because the problem has just had 2 extra zeros added on it, literally from 2008 to where we are today in terms of what they've done since. And this time to validate, justify a new system, which I think we've all got to be under the auspices is coming. I liked your mention of the power of AI getting into the wrong hands. This is going to nation stateize a globalized hack on banking system. It's a great way for them to say, we got done and it wasn't their fault, even though the banks are totally over indebted, even though they are due to fail. If you just had the black swan act of God event, and we've all got our zeros in our bank accounts. And it's, hey, sorry, and the FDIC is there for specific events. It's not there for an entire systemic failure. It doesn't have that depth to it. It can't pay everybody simultaneously £85,000 in the UK. It can't, surely not, because imagine how much money they're going to have to print. They don't have a balance sheet to cover that. Maybe one small bank goes bang. They can put a bit of a bit of a premium on the other banks. They can, buy up the shares, let it limp on for a while, and just make everybody whole. They can't systemically This is one of the big things that really upsets me, and I'm interested in your take on this. This is mood music, these deposit guarantee schemes. If you're talking about entire system failure, there is not the money in that pot. In fact, there's probably no money in that pot. It's just conjured up when it's needed for individual bank cases, but there's not going to be that level of conjuring possible if you have an entire systemic banking system fail with contagion, which is essentially the setup or the layup for the CBDC. What's your take on that? Is it even feasible that every single bank, so you're in the UK, but I mean the American equivalent will be Bank of America, Wells Fargo, Citi, JP Morgan, all cross-related holdings, one or two majors fail, a la Lehman event, you got the whole lot. The UK will be Lloyds, TSB, the Royal Bank of Scotland Group, Barclays, etc., all cross-holding, one of those majors going and the others being equally weak. Is it even feasible that could be saved again and this whole cycle extends like another 2008, or will it be the swan song in your take?
The way that I see the deposit protection guarantee is it's it's a necessary prop that the government have to give in order for consumers and people to have confidence in the free market economy. Because
I was going to say a confidence trick. I'm so glad you used it. It's almost like a confidence trick. It's something you have to say that you hope you never get called on.
100%. And so it's a hard one for me to comment on, because when I look at this commercially, I think to myself, well, actually, if they were to remove that because they don't have the means to pay people out, well, actually, removing that would probably crumble the system because no one would put money in banks because they wouldn't trust it enough. Let's face it, the reward isn't great enough for the risk. And so what the banks are doing, what the governments are doing, they are reducing the perceived risk of banks so that we start to increase the relative reward of giving money to them. Now, I used to work in America, and so I remember the FDIC, they guarantee a much larger sum than the UK. I think it's $250,000. And I remember there was a time in 2008 where the FDIC was starting to ask banks to prepay 5 years worth of insurance premiums up front. And they were doing this because, first of all, they were broke. They didn't have, the pot wasn't big enough to cover what seemed to be an inevitability of various state banks going under. But at the same time, what it was doing was it was creating a self-fulfilling prophecy, because, some of these banks that were already bleeding, their balance sheet was in tatters, for them to have to find that money to pay for something that they couldn't really afford, put them into the red.
Yeah.
And so your question is, do I think it's feasible? I think in a way, I hope we never find out. I think it is largely academic. I can't see a situation whereby we currently have enough money to cover more than 2 or 3 banks that collapse at the same time. What would undoubtedly happen is they would have to print so much cash that it would devalue the money that we already have in our pockets, and it would devalue our country's net worth relative to other countries because of the amount that we're printing.
And because of the global village that seems to be the synchronized leper colony of debt, where to join, you almost have to kiss the chief leper and become a leper yourself. This would probably happen simultaneously also because of cross-bank holdings across national boundaries. We will not get a relative place that is untouched by this. So everybody will air pocket together. So in a relative sense, there's no arbitrage to be played. Moving money to a different banking realm, to a different part of the world, because it's going to be synchronized. The key thing then comes down to assets class and how much of the correct asset do you hold. And that the only one that you'll not have taken off you, where possession is 9/10 of the law, is one of those beautiful gold bars that you make available, or silver, or otherwise.
Interestingly, just going back 1 second to the deposit protection guarantee, because there's a great film called The Big Short. I don't know if you've seen
Yes,
it. I loved
yes,
it.
indeed.
I watched it 2 or 3 times. I love the way they break it down. Michael Berry, who was the one of the minority of people that decided to bet
Sure.
on the market collapsing, and was the
Yeah.
person that actually shorted it and became an absolute billionaire for his investors. He's gone and done the same thing, right? He's bet 1.26 billion on the market collapsing, right?
Which
Now,
particular market? Debt market, equity, or all?
all
What's his
markets.
all?
He's
Okay.
predicting that what happened in 2008 is going to happen again, right? We know that if there is an explosion on the debt market, that is going to affect the equity market, because all equity markets function on debt. And I think the interesting thing, if we move back to, can banks afford to pay you out if they go under? One has to accept we don't know. We can speculate. We all have our opinions as to whether or not they will or they won't. What I find really interesting, if we base this on fact, when Northern Rock went under, that was the first bank in over 100 years that collapsed within the UK.
Yeah.
You had people queuing up around the corner, desperately trying to get their life savings out of that bank. Nowadays, it would be very different because they're closing bank branches everywhere. In fact, to find a bank branch, you probably have to drive for 20 minutes or half an hour to find one. And so nowadays, it's probably you're having to sit on hold along with millions of other people that you can't see, believing that actually you're unique, when in reality, you're not. But going back to Northern Rock, people weren't paid out straight away. First of all, it was on a first come, first served basis, and there's no real deadline. It's not like this is the deposit protection guarantee, and we will pay you out within 24 hours, right? So if we take out the speculation over whether or not they will cover or whether or not they won't, and let's just assume they will, but what we don't know is how long will it take for them to pay those people out. Now, we all have bills to pay, right? If I don't pay my energy or my mortgage, or if I don't pay for food, I'm not going to survive. And so forget whether or not my bank plan on paying me in 3 months or 6 months or a year. I might not get to that point before I'm forced to sell my house. My mortgage company, my bank, will not care that this bank has gone out of business and I'm waiting for them to pay me. They will just take my house, sell it, and raise money in place of the mortgage that I was never able to pay. And so I believe that actually the real risk is in how long it will take for banks to actually make people whole again. And if they have to print money to make that happen, I don't believe that's going to be an overnight thing, right?
No.
And that's what I think the real risk is.
And of course, as part of that money printing process and that delay process, there's the social unrest, there's the devaluation of that money. So you're actually being paid back in lesser pounds, dollars, whatevers. And in actual fact, the way that will be reflected is the gold bars you did buy will go up disproportionately in value as part of its store of value service to you, compared to the cash that you lost in the bank that you're now getting back after a huge bailout and a combination of probably CBDCs and other things that all mixed into the introduction of a new system entirely. And this will all be either through, as you mentioned, the AI nation state, Iran hacked all our bank accounts narrative. It's unbelievable. So tell us what people are selling, what you're finding as a portfolio, because you obviously in the city of London, there'll be a lot of people in the financial realm, quite senior people that are clients of yours. You mentioned, and it's quite interesting, the sort of movement away from equities into gold and almost being dispassionate about gold itself. These aren't the gold bugs now. We're getting to the mainstream guys that just saying, I need a place to park money that doesn't have counterparty risk. And I can't believe the story anymore with equities, with financially engineered and leveraged housing with super high interest rates and an overhang of supply of people with 29% of some group already in arrears on their mortgages, etc., etc. So the rest of the asset classes all being taken down. It's almost like it's not a choice. It's just the last man standing in the room. And for many of these people, we're not talking about the pet rock crowd that everybody always accuses anybody of who's passionate about sound money and gold. I'd like for you to mine that vein a little further if you can.
Sure. So it's vast. There's a vast array of different types of clients, and so what we've seen a growing trend of is people selling property. So we've seen people that have been reactive.
Can I interrupt, sorry, and ask some details? Are these primary homes, or are these people that have secondary homes? Cornwall is the second home. They live in London. Are these secondary? Are these buy-to-lets? Do you have some of that insight?
So it's both. So we work with a lot of clients that have come off their fixed term product and have seen a huge increase in their outgoings. We've also seen within the same bracket of people that have buy-to-let properties. They've gone from their mortgages being £500 a month to £2,500 a month. They're losing money from holding that property. And so that category of person, you've got personal wealth, you've got business wealth, but they're being reactive and they're having to sell property in order to run away from that debt. You've then got some of the people that foresee this risk, right? Their fixed term products haven't yet ended, right? They're still enjoying really cheap debt, but they know that in the next 2 to 3 years, they're going to be joining everyone else paying 300 or 400% more. And so they like to act from a position of strength, sell while they are not desperate. And so, those sorts of clients, they've been slightly more proactive. But if we lump them both together, we've seen a huge increase in people that have had to sell property either proactively or reactively. They're then left with cash, right? And for a lot of these people, some of these people, they're having to downsize, or they're having to move area, or they're having to pay off mortgages. For some buy-to-let investors, they're deciding to wait for the next best opportunity. But both of those category of people have cash that they don't want to leave in bank accounts for the same reasons that we discussed before. We've then got the crypto market, which is really interesting because actually we used to have a lot of people purchase physical gold as a hedge against the crypto that they were holding, given the expected volatility within those asset classes. Do I think crypto is here to stay? Absolutely. I think it's, the blockchain technology is unbelievable. It's certainly here to stay. But I think that too many people have speculated and jumped into markets they don't fully understand because they've read headlines of 11,000% growth, right? And when you see that kind of growth and people then lose, we're not talking hundreds of thousands. You see people lose their shirts. They've lost their livelihoods because they've lost money they once believed was a sure bet. We saw the crypto market, evidenced by a couple of indices fall dramatically. That's encouraged a lot of the people that can afford to risk that money into those markets again. But for ordinary people that were just taking a punt because their next door neighbor said, you've got to buy some Bitcoin, or you've got to buy this coin or that coin, they're now starting to play it safe because they've been burnt, right? They've taken a decision. They've decided to take consistency and safety and security over excitement.
Yes.
I think
those are smart people. Those are the thin edge of an ever fattening wedge. Enough people who have done enough halvening cycles, they suddenly realize, rather than doing 100x and then having 10, 15% of your high watermark at peak Bitcoin a year later, one bear market later, where you watch a whole bunch of money wash in and you watch it wash out equally fast. And in fact, many actually end up worse off because they start inverted pyramid leverage trading at the tops. You're going to end up with people that goes, you know what, I'll maybe have a little bit. I'll have a handful of XRP. I'll have a handful of Bitcoin. I'm staying out of the leverage trading stuff. It's beyond my skill sets. I'll hold that. And if it looks like it's getting toppy, I'm going to allocate to the other slow dough gold that never comes down more than, a 15% move in gold nowadays is actually a phenomenally bearish event. It's not something that happens in a day, a week. It's a bad month if that were to happen, and it usually comes back pretty quickly. So the drawdown, I remember Dr. DeMartini was saying people can take 10% on average changes in wealth. They don't lose their head about going from £1 million to £1.1 million, and they don't hang themselves about dropping from £1 million to 900,000. That is around the barrier of normal volatility that's not mood changingly critically serious. No one enjoys dropping 100k if they're on £1 million. Nobody is going to go buy a new house just for making 100k. They're not going to get giddy. But outside of that realm, that's when people lose their heads, both to the upside and actually to the downside, if they don't have great discipline and a structure. And gold tends to be that guy that's not going to. It's the good old stable pal that's always there when you need him, but not, whipping out the party alcohol and up and down like a, like a manic depressant.
Yeah, it's true. And, 10% in gold goes a long way. There's a perverse saying on Wall Street that says that people put 10% of their wealth into physical gold and hope it doesn't go up. Because if it goes up, it's an indication that the rest of their portfolio is dropping in value. And so, if you put 10% of your wealth into physical gold and we see, a collapse or a drop or a correction in the equity markets, you can hope that the 10% in gold should more than recover the 30% fall in, let's say, your equity portfolio, right? It's not exact science, but, people aren't speculating with physical gold in the same way. And I just want to clarify what I mean by smart money, because I don't want anyone to take it the wrong way. So, when we're talking about smart money, you've mentioned it, I've mentioned it. I'm talking about people that do this for a living, right? They are financially trained, they're financially skilled, they know they do this day in, day out. People pay them to do it for them. Right, so we're talking about wealth managers, investment bankers, accountants, financially trained lawyers. And so, we've got doctors and engineers and heart surgeons who are arguably smarter in some respects than lots of those people, but, they do not dedicate their time and their skill set to the financial world. And therefore, it's those sorts of people that will follow what the smart money, the financially smart money, are doing. And I think it's important to clarify that, because, in the same way as, financial experts will listen to doctors and heart surgeons in terms of how to live a better, healthier life, the doctors and the heart surgeons are listening to the financial smart money in terms of how to lead a healthier financial portfolio. That's really, really important. There are certain people that can lead by example. And the smart money, the institutions in this respect, they're governed by greed and protection. Whether or not that's right or wrong is irrelevant, right? But, if we're wanting to protect our money, then there is a huge amount of value in following what the smart money are doing and what the smart money is saying. You asked me before in terms of, what people are selling. And I mentioned property, I mentioned crypto, equities and bonds. We've also seen people that have decided to cut their losses. But I think one vehicle that is certainly worthy of mention, it would be remiss of me not to go into more detail, are pensions and SIPs. In this country, you've got self-invested personal pensions. It's the same as an IRA or a 401k in America. Effectively, a pension's primary job is to deliver purchasing power in the future. And thus, a pension's number one enemy is inflation.
Yes.
Now, fund managers attempting to balance long-term growth with capital preservation, they're seeking to at least keep up with the pace of inflation. Over the last 2 to 3 years, that's been really tricky. pursuing growth means that there has to be some sort of a heavy allocation to global equities. I'm under no misconception. If you're comparing equities to gold over 100 years, equities will win the race, right? In my opinion. And I'm in the gold market. It's what we provide, it's what we specialize in. But no one in their right mind holds one asset class for 100 years, right? It's a question of being able to hold one asset class when it makes sense, move sideways, and then hold another asset class when it makes more sense, and then move
can
sideways.
I just jump in and pre-qualify that that concession that you made about gold versus equities? Assuming you are in a tracker that is self-selecting all the best growers, and most people active in the equity markets fail to beat that named tracker. So in actual fact, the accepted benchmarks for equities usually are showing the top 90%, always normally the top quartile. Most active managers are under delivering on that. So in spite of that concession, equities often get a little bit oversold on the fact, because a tracker actively is disposing of its weight in ones that are underperforming and is backing and stacking into the ones that are. And you now have this perverse polarity where you have the Magnificent Seven, and if you took them out of the stock market in the S&P, actually the S&P's had a negative year. Everybody else. So you actually have stacked everything into one corner of the room, and they've become such behemoths of markets. And I fear they're very statist as well. They're in the data scraping and a lot of other topics we don't need to get into. But they are ever thinner, and the breadth of the market that most people might have, equity XY, mid-cap in summer old sector, retail, consumer, actually doing a lot less well, and people tend to hang on to equities on the basis that it'll come back at some point. Anyway, you did concede for over 100 years, but there are periods in that where gold is an overperformer, and I suppose our narrative is that moment coming now? Is this the point to be overweight? And in my view, and I think in yours, it is.
Yeah, so I would agree with that. And I would say that, the problem with being heavily allocated towards global equities is that it creates huge problems during times of crisis or recession, right? That's the point in which they're never going to outperform an asset class that is designed to protect during recessions. Now, if we take 2020, for example, when pension funding ratios dropped well below their liabilities, a retiree shouldn't have to worry about how the economy is doing at retirement age, right? That's the point in which you don't want worries, you don't want hassle. You read the paper for interest, but actually you don't want to have to start worrying about, the market dropping by 20% and all of a sudden you having to go back to work. And that's where gold comes in. What we've seen is gold grows slowly in good times and quickly during bad times. And as little as a 10 or a 15% allocation to gold increases risk-adjusted returns. In other words, greater returns without greater risks. And diversifying with gold it's obviously beneficial, but during good times, and even more obviously beneficial during crisis. And so if you look, there's a chart that I can send you later that you can share with your reader, that you can share with your audience, that shows you what portfolios do over a 50-year period if there's gold within it. Your adjusted increase after inflation will perform that much better for having physical gold within it, right? That's if you're looking at physical gold as a hedge. But if you're wanting to kind of avoid this dance of the kind of 2 steps forward, I grow my portfolio by 20% in the equity market, and then 1.5 steps back, I've just lost 18%. And you continue doing that dance all the way out to retirement to find yourself in roughly, 10% higher than where you were 30 years ago. The smart money, they're not playing the same game. They're moving 2 steps forward. They're moving sideways. They're probably crystallizing gains early to the point where the market continues to increase, but they're looking at the market holistically. They're looking at fundamentals. They're looking at other asset classes like physical gold that look undervalued, right? and they're taking a contrarian defensive play in an asset class that tends to protect during recession, right? Gold then increases, you move sideways, you take advantage of equities, bonds, or property that have taken a haircut because of the recession. And if you're able to play out the cyclical cycles of different asset classes, then effectively you're going to do far better than basically, standing still and experiencing the 2 steps forward, 2 steps back phenomenon.
100%. Yeah. There's so much value in that. In fact, I on our Crypto Sniper channel was just taking some umbrage with Michael Saylor, who was going, if you're not all in Bitcoin, you're irrational, was essentially his statement. And he described, there's this one boat that's Bitcoin and there's 9 other hold boats. And, are you going to diversify and put a family member in each of the boats, almost in this kind of a narrative. And I was, wow, there's someone who's just trying to debunk the very well established portfolio theory and also the risk adjusted return rather than the absolute return. Because even if he was correct and Bitcoin does absolutely moon and it's not deemed a competitor by the central bank digital currencies, because how do you have the one without the other? I'll dump all my CBDCs I get given for Bitcoin, given the choice. But anyway, let's just pretend it does and it goes to 100,000, etc., etc. You're going to have the volatility in your mood and your net worth that will go with that level of return. Whilst if you've got a lower absolute return, but you had 50% of that in gold and 10% in silver, you will get a lower absolute number, but you're just not going to have those good, crazy good days and those terrible days where you drop 25%. And that is the performance. Many people always think the absolute number is the God number. And I would say someone who was delivering, this was what Madoff eventually got pulled on. He was delivering low teens, but so consistently with virtually no up-down variance that the risk-adjusted return was what was unbelievable. Buffett's delivered in equities much higher numbers, but for the variance, and it's the guy that gives you no bad days. It's the drawdown days, because it's always when you need your money most that it's usually in the drawdown environment. Yeah. Because when you're panicking and you're dipping for your money, it's when you're in your drawdown environment. When things are growing great and you're feeling rich, you don't need your money. You're like adding more into the market. So I have found it really hard listening to that without rebutting it, because there's so many people in the YouTube market that are not of his wealth, that probably don't have the 10 homes he probably has, the fleet of cars, and across various countries and nations, or the cash generative MicroStrategy that still has an operation that is not Bitcoin orientated. And they will assume that means I have nothing else but Bitcoin. And they will take, their £100 or their month and add it in, and they'll go all in. And then they're going to have one heck of a roller coaster ride. And the likelihood is they're going to be forced sellers at a point of the low rather than manifesting the crazy headline number. And this is the comments I made about equities as well. It's not the headline number. It's when you have to sell. It's when you are pension age. It's when you're under pressure that you need your money. It's the banks always take the brolly away when the rain comes. It's that natural law that you're going to be at the low water market. You actually want the most stable asset that has the least pullback, because you're most likely going to be calling on it during a tough time. And the tough times are synchronized globally. Most people needed money and support in the bottom of 2007 and 8 and 9 and the years that followed that. They were feeling great in 05, 06, 07. And it's frustrating that people don't get that. Michael, it's been, my apologies, Joshua, it's been great talking to you. What is your take on Michael Saylor's positioning there? And do you have any closing arguments before I give you an opportunity to answer why pure gold again?
I think it's dangerous to back just one horse in any market. And I think one has to decide when they're investing in an asset class how much they can afford to lose. And so I think there's certainly mileage in speculating within the crypto market. 100%. We've seen some of these unbelievable gains. And so if I could afford to lose £500, I'd spread that around and put that in various different coins, various different cryptocurrencies. If I can't afford to lose that, I'm not going to speculate and put it into something. And so I just think, putting it into one asset class, putting it into one coin, so that actually your gains are higher, but your losses are much lower, just puts you in a far riskier situation than I would ever want to be. People look at gold in a very, very different way because they don't tend to look at it as a traditional investment, because investment represents the possibility and expectation of loss, even long term. Whereas people purchase physical gold for completely the opposite reason. They're looking for safety, they're looking for security and wealth preservation. I would never suggest that anyone to liquidate their entire portfolio and put everything into physical gold. Even if I were to believe that gold is going to triple over the next 5 years, would I still suggest that someone actually sells everything, puts it into gold? No, because I think the key is, first of all, diversification. Second of all, it's about good habits, and it's about consistent habits. And so, you might get lucky once, but you won't get lucky twice or three times. And it's
if you practice being a gambler, you become a gambler. You become what you practice. And I love that principle, Joshua, and that restates what a sound man you are. And tell us why folk, and we'll have the link below to Pure Gold in Joshua. Why should people choose Pure Gold? There are other purveyors of precious metals in the world. Your particular organization, what's the upsides in dealing with you?
So we're an investment company. We're not a shop. We don't have an e-commerce store with thousands of products. What we are proud about is the consultative approach that we provide every single one of our clients. We explain how it works, why it works, and also when to do something, when not to do something. If we've got a client that wants to make a purchase today and we believe there's going to be a movement in the next 2 or 3 days, we may well request they consider waiting by 2 or 3 days, to pick up more gold for less money. If we think the converse is true, we may well say, well, actually, today's probably a good time to get started. We provide certificates of authenticity for every single purchase at the point of sale. We provide a buyback guarantee, whereby we guarantee a means of instant liquidity as of when a client requires it. We don't pay below the spot price, whereas most of the other e-commerce shops out there, they're paying kind of 96% of the value of the gold that you're purchasing, whereas we never purchase below 100%. And that's a big factor, because effectively, when you sell, when you need to raise liquidity, you want to make sure that the firm that you're selling to isn't taking a huge haircut off your portfolio. So we don't do that. We're regarded as thought leaders. You can see us in the press. We were on GMTV about 3 or 4 months ago. We were asked to bring in and showcase £1 million worth of gold bars and coins. And we were asked to do that because, again, we get to speak to every single one of our clients. So we understand what motivates the market. We understand why people are doing what they're doing. And so we can give that guidance to people that haven't yet made their first move. Our brokers have experience from investment banking, property, foreign exchange, the legal world. And so we like to think of ourselves as having, a worldly and holistic perception of the world. It's not just kind of single-mindedly gold. And so what I would suggest, everything starts with knowledge. I believe that knowledge is key, it's power. And so to visit the link that Francis will provide below, to follow the link, to download either an investor guide that will give you some more information, to book in a consultation with one of our brokers who can give you a lot more information tailored to your specific requirements for you to find out if this is something that you want to know more about. It's important that once if you're deciding to put your money into anything, it's more a question of discounting the alternatives as it is about kind of affirming them.
100%. Last man standing in the room is almost the analogy I come up with. Joshua, that's been absolutely amazing. By the way, for everyone watching, I purchased from Joshua and his team. I have not had a single adverse interaction. It's always been professionally conducted. You can call, you can email, you can take it on. I would certainly suggest the call for the initial instance so that you have a name and a face and the personal characteristic. It's the personal touch that matters. The spot instant liquid buyback is absolutely part of it. By the way, they also make available platinum and silver and the other metals apart from gold, and in many different forms, weights, coins, etc. It's been great chatting, Joshua. I want to wish you all the best for 2024. Any final words before we let you sign off?
I would just say, proceed with caution, but optimistic caution. There's a lot to be frightened about, but actually there's also a lot to be excited about. It's not all dreary. And so, like I said before, sometimes the hardest thing to do is nothing. Sometimes the hardest thing to do is to wait for the opportunities to present themselves. It's just a question of how you wait.
And gold being one of the best long-term parking bays for capital and counterparty risk while you wait as well, just to almost finish your tagline. That's been absolutely awesome. Joshua Saul of Pure Gold, CEO and founder. Really awesome to have you on. Thank you for giving us your time. And don't forget the link below. You can start today. What's the smallest amount as a parting shot that people can start on and to engage with your company for some of the smaller accounts on a monthly, because you also offer a dollar cost averaging. I'm just remembering that as well.
So our starting point, our minimum transaction size starts at £5,000. And we do that so that we can give the premium consultative service that our clients kind of expect from us. We're not providing at the moment the accumulator product. That's something that I hope to kind of advise the market on shortly. But at the moment, it's physical gold, physical silver, investing through your pension or SIP. We provide storage for all products within a London bullion market approved vault, and minimum starting positions at 5,000 with no upper limit.
Got you. So not yet a dollar cost averaging, my bad there, but potentially in the future. Joshua, thanks so much for coming on. We really appreciate it. Bye for now.
Thank you. Thanks for having me.